90%. That's how much of every dollar spent drilling for oil today just replaces what's already been pumped out. Not to grow production, not to meet new demand, just to stay even. Think about that for a second. Imagine running on a treadmill that speeds up every year. You have to run faster and faster just to stay in the same spot. That's what's happening in the oil industry right now. And here's the thing, the companies doing the running. They've been burned so badly over the last decade that they don't want to spend more money. They're exhausted, they're cautious, and the math is starting to catch up with them. This is the story almost nobody is watching. While everyone argues about AI and tech stocks, something much bigger might be brewing in the energy sector. Let me take you back to 2014. Oil was above $100 a barrel. Companies were drilling everywhere. Money poured in. The party seemed endless. Then the floor dropped out. From 2014 to 2016, hundreds of billions of dollars vanished. Companies went bankrupt. Survivors slashed their budgets and fired their crews. Then shale came along. That's oil trapped in rock that you have to blast out. It promised to save everything. Instead, it made things worse for a while. More bankruptcies, more pain, more companies learning the hard way that this business can destroy you. So what did the survivors do? They stopped being aggressive. They stopped spending. They started returning money to shareholders instead of chasing new wells. For the first time in the industry's history, discipline actually took hold. That caution made sense then, but now it's creating a problem because demand never went away. Here are the numbers that matter. Conventional oil fields lose about 5.6% of their output every year naturally. The wells just produce less over time. Shale wells, they decline at 35% per year. That's not a typo. A shale well that looks amazing in year 1 is a shadow of itself by year 3. Meanwhile, the world burns through 103 million barrels of oil every single day. That number has grown every year for the last decade. The only exception? 2020, when a pandemic shut down the global economy. That's what actual demand and destruction looks like. Everything else has been growth. Now look at XOP. That's an ETF, which is basically a basket of oil and gas production companies bundled together. In the last big cycle, it peaked around $350. Today it sits at roughly $159. That's less than half its previous high, even after a recent breakout. So what does this mean if you're building a retirement portfolio? First, let's talk about what everyone else owns. The S&P 500 right now trades at a CAPE ratio of 37. The CAPE ratio measures how expensive stocks are compared to their long-term earnings. A reading of 37 is extremely high. The only other times we've seen numbers like this were the dot-com bubble peak in 2000 and briefly in 2021. That's the crowded trade. That's where most passive investors have their money. On the other side, you have energy. Cheap, hated, avoided by most funds because it was toxic for so long. This is a classic setup for patient investors. You don't need to believe oil goes to $200. You don't need a war or a crisis. You just need the supply map to keep doing what it's been doing. And you need prices to eventually reflect reality. That's how mean reversion works. Let's be honest about both sides. For energy to work, you need demand to stay steady. If we hit a severe global recession, oil consumption drops and prices fall. That's a real risk. You also need companies to stay disciplined. If oil prices spike and everyone starts drilling again, the oversupply problem comes back. That's happened before. On the upside, XOP could double within 3 years. That would mean the average oil and gas producer returns to something closer to its previous peak. No heroic predictions needed. Just steady demand meeting constrained supply. The breakout from the multi-year trading range suggests momentum is building. When prices compress for years and then break out, the move can be fast. All those investors waiting on the sidelines start moving at once. That's what the article means by compression breeds violence. Here's what you need to remember. A decade of pain has starved the oil industry of investment at exactly the wrong time. Demand keeps growing. Supply keeps declining. The stocks are still priced, but the bad times never end. If you're watching this far, you already think differently than most investors. You're not here for hot takes or meme stocks. You're looking for real ideas where the math actually works. The crowd hasn't figured it out yet. That's what Capitalist Experts was built for. Chris McIntosh and his team are professional fund managers who invest their own capital in the same ideas they write about. Twice a month, they publish the Insider newsletter with 5 fully researched opportunities. Limited downside, explosive upside potential. Sectors Wall Street won't touch until the price is already moved. The Insider is $35 a month on the annual plan. Stop guessing and start investing with an actual edge. The link is in the description. Don't miss the next one.